regulations, and customer experience. I am pleased to welcome the panelists to the dais. Mr. P.R. Sheshadri, MD and CEO, South Indian Bank. Mr. Binod Kumar, ED, Punjab National Bank. Mr. Rajiva, ED, Punjab and Sindh Bank. Mr. Umesh Revankar, Executive Vice Chairman, Shri Ram Finance. Mr. Sudipto Nag, President, Axis Bank. Mr. Pankaj Sharma, Chief Strategy and Transformation, Yes Bank. And our moderator for this session is Mr. Abhinav Bansal, MD and Partner, BCG. May I request Mr. Abhinav to initiate the discussion? Over to you, sir. You can start, yes.
Okay. If I could just request the people on the sidelines to settle down a bit. Thank you. Thank you very much. A very good afternoon to everyone. I think the session before the lunch and after the lunch are typically the toughest one. We'll try and keep you awake through the conversation. There are, typically two schools of thoughts, and we might agree with either of them, right? Either we are in the business of lending or we are in the business of collection. Right? I'm really glad that we are finally addressing the second school of thought, even though they might be in minority or majority, depending upon the perspective we look at. But really, really glad that we are taking up this topic for the first time in the FIBAC conference. So I'll start with Mr. Rajiva. Sir, before even we start about collection, I think there is an aspect of controlling delinquencies on the basis of underwriting, and then there is on the basis of collection, right? Which one of these knobs do you believe are a bigger lever to control delinquencies, and in what situation? Because it also depends upon what time frame and what time zone you're talking about.
So thank you. Avinav, you asked me that question. So whenever we talk of collection, it is very important that we look at the starting point, and that is where you call it credit policy or the underwriting practices, all those things become very, very important. Because that is the origin of, I'll say, all the issues which might crop up later on and might need various steps for getting the money back. So it is very important that we pay proper attention to credit practices, which essentially means that you have proper skill set, you have proper risk appetite, you have proper policies to understand whom you are lending, what you are lending, what are the terms on which you are lending. And once you are very clear in all these aspects, I think the journey ahead is going to be very, very smooth. And of course, once you have taken care by use of technology, by use of adequate practices, the next steps will be the post-disbursement phase, in which you need constant look at what is happening to the particular account. And if the post-disbursement phase also is smooth, I think the typical collection phase will be quite smooth, and you need not actually have to make a lot of efforts as far as collection is concerned. So looking at two things, I think more effort has to be made on the credit origination, credit underwriting practices, if we want to see better collection strategies, better collection results overall. So it is very, very important that we have adequate underwriting practices.
So I completely agree, sir. I think at a meta level, prevention is better than cure. But there is a reality that, yes, ultimately we are servicing segments where it is difficult to control delinquencies, right? And then in that context, especially right now, we are going through a phase where there are elevated levels of delinquency in the unsecured segment, and we have seen how regulator has reacted to it. So, Sudipto, that's where I want to get your thoughts. You have dealt with some very large portfolios with some of the largest banks in the country. How do you see, in an environment like this, what are some of those immediate steps that one could take to release pressure in the ecosystem?
Yeah, thank you. Largely, if I look at the unsecured growth, been substantial and it is growing. If I look at the overall pie of the credit in the banking system, is gradually moving. And today it is landing up almost like 12 lakh crore. Having seen such situation, regulator has largely responded well on time in terms of increasing the risk weight ratio. But what's there for the bank to respond to what credit bureau and to do it? Largely on the banking side, what I feel that it is time to look at the last 5-7% of the segment on an ongoing basis by cutting the data at a micro segment level to see which are the segments which are leading to disproportionate increase in the credit loss. Because unless we keep on doing it and sharpening it, the PBT will always come under pressure. And while one is doing that, it is also important since larger part of the lending is today digital in nature. The journeys are to be looked at, are we doing adequate in terms of the KYC validation, income validation, in terms of employment verifications and all. Those are very, very important aspect to it because you can have a very strong model scorecard. Because the input data, if it is not strong, which is flowing where the entire model is being bent, so there will be a leakage. So we have to respond to both the point in terms of data quality as well as the scorecard model. I'm coming on to the third part, which is largely to do with the credit bureau. Today, when we look at large part of the customers, it's not like they are defaulting. They have shown enough symptoms of credit hungriness, be it in form of multiple inquiries, leverage, or could be frequent unsecured borrowing. So given that situation, if the daily reporting of the credit bureau happens by all the institutions and ecosystem-wise, definitely bank will be in a position to read it, NBFCs will be able to read it, and will be able to take preventive measures. And lastly, in the leg, when it comes into collection, pre-delinquency management is one of the things which every institution should have, reading on each of the micro segments, and making sure that we educate customer. Can we push a bureau simulator where customer can read those scores, ramification of not paying on time, what could be the consequence in terms of bureau score? Because it is the time when we are digitally lending and when technology is playing the bigger role, a behavioral shaping is also very, very important aspect. So that's my take on this.
So you made multiple points, and I think some of these we'll revisit during the panel discussion as we move ahead. Data you talked about, analytics you talked about, even the integration between what's happening in collection and the processes of lending, and what kind of changes need to happen in the journey to be able to enable collection. So we'll touch upon many of these points as we move along. But Mr. Binod, I had a specific question for you, sir. There are many things that Sudipto talked about that these are, I would say, the brain of collection, right? That it will tell me what to do. But finally, it needs to be operationalized on ground. Collection is definitely one of those things where it is 10, 20, 70. You can think, you can create digital processes, but then there is a large part that happens out there in the field. In that context, how do you balance between in-house and outsource activities? There is a pace at which you are expanding, and then there is a pace at which you can expand your collection capabilities and capacity. How do you create that balance and across the value chain of collection?
Thank you, Abhinav, for asking that question. So I will, before coming to the main point, I will give some data, and then I will come to the main point. Data may not be necessary of my bank. So few years back, when our SMA book was, say, 23-24%, slippage was around 3 to 3.6%, around 4%. Now, if we talk of today, when SMA is around 10%, slippage is less than 1%. And it is happening with the industry also. So the learning thing is, our endeavor should be to push the account out of SMA. Slippage to SMA should be minimum. If that is there, our collection burden on collection efficiency, collection will go down. So that should be the main thrust of the banks. Coming to your first question was very pertinent. So how to do that and how to strike a balance? First of all, we should have a very well-defined underwriting process. Unless we have a very strong underwriting process, you may put in n number of efforts, but collection may not happen. So that is the strong point, that we should have a very strong underwriting standard. Then again, as you told, even after you have a very strong underwriting standard, there will be slippages. So what to do with that? So first point, my thought process is we should try to move standard accounts towards 100%, which may not be possible. And to do that, first point, internal. Internal, we can do many things. First of all, I will suggest collection accounts should be with the banks. So if we can control cash flow of the customers, most of our problems are solved. So first emphasis should be given on that. For that, we may have operational account, not mandate, or we can give QR code to the customer, we can give a payment gateway, we can give them collection accounts, etc. So there are many channels. Now question comes, even if some slippages are there. There are many channels, and in PNB, we use AIML also, and we use collection propensity score. So collection propensity score, you defined it into 3 categories: PR1, high risk; PR2, medium risk; PR3, low risk. So based on that, we try to collect and contact the customers. And also, we have behavioral and nature study of the customers. So that we try to strike balance between the internal and external. But our focus is we should stop from slipping to SMA. Because that effort is still, I will say, minimum. Once it slips, our efforts will be many times more. So that is the way we approach. Thank you.
I think that's a fair summary. But Sesh, I have a point related to what Mr. Binod just said. Yes, I think multiple panelists agree that underwriting is the place where it starts, and even then there can be slippages, and then there is a whole conversation around data, analytics, everything is fine, right? But it still brings us to the point that collection is done in the field. And for the banks of the size that you lead, it is a large number of people who are involved in this. And there are pressures around that you need to collect, and things can go out of the hand. The SOPs are not necessarily followed, and there is a compliance and regulatory risk attached to it. How do you draw the balance, right? And how do you make sure some of these guardrails are followed on ground?
Thank you, Abhinav, and thank you very much for having me in this panel. The question you ask is a very pertinent one. I think environment has evolved a great deal, and today it's a little bit easier for us to be compliant than it was in the past. And the reason I say this is that, in the long and distant past, I used to be the head of banking collections for Citibank between the years 1998 and 2000. That was a time when the legal framework had not yet been fully established. Many of the processes that are commonplace today were being invented, and very often being invented by the bank that I worked for. And finally, there was very little downside risk for the customer if he were not to pay us. Today, there is a very clear price that somebody pays in the event he or she defaults. That did not exist because the bureaus had not yet come into being, and therefore, there was no downside for somebody not to pay. Under those circumstances, collections was much, much more difficult, and in fact, in some ways more rewarding. In today's environment, it is a balance between maintaining the customer relationship and ensuring that you get paid. So there is a downside for the customer for not paying. Therefore, if you pressurize him too much, you lose that relationship. B, if you pressurize him too much, what happens is you end up getting paid for the first 2-3 months. Then there is another bank that is not being paid, who then start pressurizing him, and then he deprioritizes you and pays the other bank. So it's a round robin, and therefore, in my mind, there is very little benefit for you to be very, very aggressive in collections in today's environment, because there is a price that customers pay for not paying. So now it is the balance that the bank wants to maintain, about maintaining that relationship and maintaining the financial integrity of the bank. You need to work that out, but it's much, much easier today to be fully compliant. For one, I believe, having actually been a collection manager, I believe today the use of the field, I think, is overstated. Very often, collection practices and some of these things that we talk about, how we use models and how we do test and learn and all those kind of things, we tend to do that when the portfolio is behaving well. The moment the portfolio starts behaving badly, then what we do is we invest a great deal in collection expenses. And it's very hard to figure out what you're getting more of, expense or actual collections. You know, from a managerial point of view, that's the thing to do, because that protects you. But at the other end, it exposes you to these kind of risks that you mentioned. So my view is that banks should figure out how to underwrite assets that you can collect on the phone. The moment you have to get to the field, that's when the problems occur. And the phone can be monitored very nicely. And my view today is that the field is actually not particularly efficient, nor does it actually pay you in an environment where the customer can lose for not paying you.
I'm seriously struggling to find people who believe in the school of thought that we are in the business of collection. You're the third person on the panel who has said that underwriting comes first, and I think maybe that's where the truth lies. But I think, Sesh, what you mentioned, which I probably missed in my question, is that it's not about compliance and regulation so much. It's really about the customer experience, and that's what probably the regulator or compliance is trying to try, right? And it's about the relationship that you want to maintain, right? And hence, beyond a point, whatever we do is not going to change the reality that there is an ability to pay gap. If it was a willingness to pay gap, that should have been addressed in your underwriting itself, right? Fair point. Umesh, I'll probably come to you on this one. You lead one of the largest NBFCs in the country. And as an NBFC, we do not have the privilege of a certain cost of fund, and hence we operate in a certain segment of customers for a certain yield, right? Which have a tendency to be higher in terms of risk profile. Do you believe that a strong collection capability, can that be a business model differentiator? Can that be recognized as by the market, by the investors, by the stakeholders as something unique in a business model? Is that a possibility?
Yeah, thank you. So the moment you say a strong collection practice, it looks as if it is use of muscular power. I'm telling you, there is nothing like that. So yes, we do cater to certain segments who normally do not get served or lent by the banks. And most of them are individuals, self-employed, who want to do their own businesses. And most of them may be having their own assets, shops, run. And they may not have a formal banking arrangement, credit arrangement. They may be having bank accounts. So that is the kind of customers typically NBFC catered to. But what the NBFC does is most of them have direct access to customer. They know the customer, and they have a specialization, either geographically or in the particular business which the customer is in. So by and large, the NBFC model knows the business and the customer. So we know the cyclicality of the business, and the underwriting standards are developed accordingly. And there are always, you can see that moment you go to little new, or called new to credit kind of a customer, our lending rates will be higher. So that means the credit cost is inbuilt in the lending rates. So when a credit cost is inbuilt in the lending rates, then you can't complain and you can't compare that particular portion with a AAA rated customer. And because generally what is happening is we compare with others bucket and see this is bad. But see, you have already priced it and therefore it is not really bad. You have to see over these cycles, over the maybe 10, 15, 20 year cycles, has it paid you the net return, what you planned for? If it is giving you net return, then higher credit cost should be okay in that particular segment. That's how I think, see, the NBFCs have developed a model based on understanding the business of the customer and knowing the customer. So I think, therefore, collection looks a little better or maybe a little sharper, or maybe we don't complain about it. And also, another angle to see is that the outsourcing part of it, collection outsourcing part of it is not really done by the larger NBFCs who are there in the business for a long time. Moment you outsource, then you have a challenge because you do not have control over the outsourced agents or outsourced companies. And that's going to become a little tricky issue. And therefore, I think by and large, I don't really say that NBFCs have better collection mechanism, but only I can say that we relate to the business, we relate to the customer much better or maybe much deeper and deal them as a partner. So that's the difference.
No, I genuinely believe this call on keeping collections completely in-house is probably a tough one to begin with, but it does yield significant benefits in the long run, right? As you rightly said, your own employees can interact better with the customers, they can know their reality better. There is more transformation of information within the organization, right? If there is a disposition at collection, right, that transformation, the feedback loop with an outsourced agency might be a bit weaker vis-a-vis if it is an in-house, right? So some of these are very structural choices, right? And I completely agree, it's not about the muscular part, it's more about the strategic intent with which you take some of this. Pankaj, I'll probably get your thoughts now. You have led many of the transformation officers at some of the largest banks in the country, and you are leading one even right now. How do you see collection as a function transforming in times like these and in future? What are some of the trends that you are picking up?
Thanks, Abhinav. I think I'll answer this question on 3 vectors. First one being collection journey automation. I think when we speak about a lot of processes, we talk about onboarding journey, we talk about credit journey, but I believe the time has come where the end-to-end collection journey automation is also an important aspect, and that's very important today, more from effectiveness, efficiency, and also from the regulatory framework perspective. Because it's important that whatever we are doing, it's completely recorded, we give the right payment options to the customers, and we have omni-channel presence coming across for the customer and the interaction which is happening. The second vector being analytics and collections. And again, going by what Sesh said over here, it's important that we take the inputs from how are we going to underwrite also in the collection scorecard. And also take the reverse inputs from collection scorecards into the underwriting scorecard. So we should be today building scorecards both at the onboarding stage and collections which have the ability to take the inputs from both the sides. And third being, I think the previous topic covered the use of AI and GenAI. And we should see that how we start utilizing this on the collection space also. So there are pretty interesting use cases which are coming across which help in increasing the effectiveness of the collection, specifically on the outbound side and the phone side, as Sesh also mentioned again, that's going to be the biggest play in terms of how we effectively collect through the phone mechanism. And it's important that the new tools like your NLP We understand when the customer is answering and when he's promising to pay, whether he's actually promising to pay or he is not would be paying in the next time. So I think all these elements, many of the institutions have started using, also to improve the effectiveness of the outbound calls, which are doing using of conversational bots. So there's a lot of work which is happening, and this is really improving and transforming the way the collections was also being done across.
I think the part around analytics is, I think, somewhat getting appreciated. But I really found insightful is the whole point around journeys, right? And you're absolutely right that we have focused on onboarding journeys quite a bit. Sudipto talked about that there has to be a collection feedback going into onboarding journeys, but there is also a journey within collections, right? How do we simplify that? And in fact, that comes to your experience, operating risk, many aspects of the journey which can be simplified. Sudipto, I just want to double click with you once again on analytics data, right? I think everybody talked about this, and Pankaj illustrated that on underwriting, it has taken us a lot of time to believe that it can be an STP underwriting. And even today, unsecured is still STP, and secured we still like to do a touch and feel, right? That's the mindset with which we have approached underwriting, right? And it will take still some more time for us to get comfortable with taking decisions, while all of that is completely data backed, right? So collection, which is a lot more operational than underwriting, right? A lot more in the field. How far are we from believing in analytics as an industry for collection, right? Are we really using that? Or is it like, yes, there is a BIU, there is an analytics team which exists, which churns out certain insights, and then there is an independent collection team that acts on it. Where is the marriage of two?
So I will first look at the larger picture. What are the big shifts which has happened in the ecosystem? First, in terms of demography, who are borrowing? It's between 25, larger part of the borrowing is between 25 years to say 40 years, constitute about 60%. Smartphone about say 65 crores, 82 crore internet users. These are, and that ease of computation, ease of being cloud available. So everything has become much seamless, and hence the lending has become, to the last mile, it has become much seamless. The question what you ask, are we in a position to reach that? How data analytics will come in? Definitely, the speed at which lending is happening, there is a need to catch up on the collection side use of data analytics, right? If it is not well orchestrated, definitely there is going to be a gap, because the reach which is happening at the last mile, analytics should come till that level. So are we doing enough in the industry? I think a lot to happen. But what one can do it is largely in terms of micro-segmentation of the entire portfolio using machine learning to identify each of the small segments. What are the personalized treatment can be done from the point of, as specific as the content designing, or what type of SMS, IVR bot should be pushed to the customer. It is no more a generalized strategy. It is a specific strategy, tailor-made strategy which can be pushed to the customer. And also there is an AI layer which comes when the campaign engine comes. Between bot, SMS, IVR, email, even in case of in-housing, when the orchestration will happen so that the right customer, right place, right time can be made. While it is happening, the outcomes need to be augmented, and that should come back into the system. So it's a complete process in itself to make the entire engine sharper. A byproduct will go into the credit side in terms of making it even sharper. So none of the outcome should go waste. That's one part to it. But having all this in the overall workflow system, are we in a position to make it? Because most of the organizations will have today collection workflow system, but are these systems are indeed intelligent systems? The answer is no. Lot of things are happening in the form of a modularity of it, which is not a common thread. There is a need for a Gen AI, where all those strategy layer can be there in the Gen AI, so that the changes will happen. The brain will be the Gen AI, and each of those strategy can be executed through that. So I think a lot can be happening on it. But at the end of the day, what I could hear from Pankaj, Shesh, it is all about balancing between loss, cost, and reputation risk. More and more we do outsourcing, we are exposed to reputation risk. But there is a need to also not only on the change on the analytics side, but also on the entire approach. Calling collection manager is a collection manager itself, I feel there's a time to think, why can't we call them as a relationship manager? Because the trust and the believability of the entire ecosystem need to change. There are people who are there to connect to customer to help them. But more and more we use collection manager, those mindset need to change today. So that's my take on analytics on the entire overall landscape.
No, I think, as you rightly said, the absorption of analytics is at two levels. One is there can be digital actions that can be taken on the back of that, and then there are field actions that need to be taken on the back of that. At least the digital actions are centrally driven, right? That should be the step one. Like for underwriting, unsecured was the step one, right? Maybe for collection, the digital actions which can be done centrally is the step one to absorb analytics. But Pankaj, I want to do a double click on this, and you mentioned some points around data. Much of this analytics that Sudipta is talking about is also dependent upon data, right? And data at two levels, one internal data and the external data, right? On internal, what is the authenticity and how do you create data which can be used from collection perspective? How do you store it, etc.? Externally, what all data do you consume? There is account aggregator that is coming in. What are the other sources of data? And any thoughts on the data privacy laws, if they come into effect? How do they change some of the things that Sudipta is talking about?
So let me again address this on a couple of points. One, I think everyone is aware of how the banks or the NBFCs are internally using the data, so I'll not talk much about it. Let me talk about the new interesting trends which are coming. As you would be aware, today the majority of payments are moving towards UPI. So UPI and alternate source of data becomes a very interesting proposition to understand what's the customer behavior, what kind of payments are being made, and how we can get the learnings into collections and the cash flow mechanism. Second, I think you made a point on the account aggregator. That's a very, very interesting point which is coming across. So traditionally, you can look at account aggregator data in two ways. One, to understand the broad cash flows of the customer through the analysis of the bank statements. Second, have some persona-based collections, depending on what kind of trends you see on the statement, whether he is a lazy payer or you believe we need to do a hard collections. But I think today's date, this account aggregated data has become very, very pertinent because if you would have seen the latest trend in last couple of quarters on the unsecured side, what we've seen a new trend is that the people who are defaulting, they have taken multiple loans and they've been over leveraged. So on the collection side also, then it becomes very important that you are the first one to collect. Because if there are 3 banks or 3 NBFCs, the person has defaulted, then if you can look at the account aggregated data in the right way and ensure the moment the cash flow or the money comes in, you are there giving through the nudges or through the call and everything, you would be the first one to get the money. Otherwise, you would, by the time you call up after 5 days, someone else would have already collected. So these are very interesting trend which is emerging specifically from the delinquency behavior which you've seen in the last couple of quarters, where it's not a normal delinquency. You've seen people have over leveraged and they've taken multiple loans. Some new trends which are also emerging and looking at some more alternate data, I think, which will take some more quarters to really develop. One is on this whole new data sets which are coming, like your SatSure data, what kind of satellite data which we can look at, simple data like the FASTag usage, and the IoT-based devices. Like today, many of the vehicles come with IoT-based devices, and many of the manufacturers today really understand how the whole economy is moving. Like yesterday, we were discussing with one of the large players. We are in a position to predict how the whole GDP is moving, because how many kilometers the large trucks have been doing on a month-on-month basis. So the same data can also be used to, again, look at the cash flows and see how we can build collections mechanism around that. So pretty interesting.
So I think a very interesting point that much of the high frequency, high volume data, which we are probably going to use for underwriting, is even more apt for the collection use cases, right? And it has not proliferated as much as it could potentially. And Satshore is a fantastic example, right? It's a very tangential, very specific farm lending, agri lending, and so on and so forth. Absolutely. Mr. Rajiva, one question from you, right? Pankaj talked about there are journeys in collection as well, right, which need to undergo change. In your perspective, what is the role of tech and digital in collection? How are you seeing that evolving?
So when we spoke about the start of the journey, of course, all of us have spoken about the underwriting. Now, post-underwriting, there will be phases. And as Binodji spoke, the second phase could be delinquency, initial delinquency for a few days. And that is where there are softwares available, there are journeys available which tells you about early warning signals in the accounts. And they clearly demarcate what are the initial problems. And if those problems are tackled at the initial stages, then it need not go for next phase of collection. So early warning signals, they are very, very important. And when we actually go into the collection of assets which are slightly under stress, then again, you have a number of journeys, softwares available in the market, which gives you exact time and date when the money is going to come into the account. And you can, as Pankaj said, you can lay your claims on that. In fact, there are some of the banks which have even gone digital as far as one-time settlements are concerned. So they are rule-based engines. And in case, particularly for small ticket advances in MSME and agriculture, if you fulfill those criteria as per the rule engine, online settlements you can do, and you can get no NOC from the banks. So again, the digital journey throughout the initial incipient sickness phases, as well as through advanced sickness phases, they are there in the market, and they can be taken help of in order to ensure that the entire collection process is smooth.
I think the biggest unlock is still in the DIY journeys, right? Where some of the digital processes, customer journeys can create a huge unlock. And then, of course, the operating risk, right? Even if there is a phygital process to it, how can you minimize and while we can have the entire team in-house, even then, there exists an operating risk which can probably be minimized. Umesh, on this point around in-house, I still want to ask you one question. While as large NBFCs and banks, we have a strategic choice to make that we want to have in-house versus outsource, but we are in an economy where there are many small fintechs, very small NBFCs who are getting into this business, right? And at that scale, it's probably not possible to have everything in-house, right? And then there are business models emerging around collection as a service. Many players are offering that in multiple shapes and forms. They are a plug-and-play solution, right? A, do you think it is a viable business model? B, what are some of the risks and positives you see with that kind of a model as a collection as a service?
See, before coming to that, I would like to tell you that last 10 years have been a significant journey in the sense the post-UPI, digital, GST, and even the recent COVID. Entire the behavior of a customer has totally changed. Today, even a small vendor or businessman, he is able to use a digital mode to transfer his money into bank account and then use it. So, in the past, many of the businesses were struggling. They only will collect cash, will pay in cash. The cash transactions were quite heavy. Today, he has a choice to make it everything digital so that he can pay on time, or even he can make the part payment 24/7. It is not that he has to go to physically go, or I should send somebody collector physically. Those things are not there. In the absence of that, there is a total change in the the environment. And today, structurally, I think the individual behavior or discipline has become much better. So in this environment, whether you need a specialized collection team is something which I'm not very sure. Maybe you can have some local arrangement with very small scale, but to have a large scale collection team specialized and having a business model out of it is something looks very not viable to me, because maybe the data analytics and the smart usage of various variables, all those things are possible by the company by directly having outsourcing specialist, not exactly outsourcing everything. You can collect information, but use it as if you doing it. In the sense, it has to be part of your DNA to use it, and so that you learn out of it. Otherwise, no, you just outsource it and forget it. No, that kind of attitude can come. So many of the activities today, large, when you become very large, you try to outsource it and try to become, the specialist in few activities. I don't think that will work, is my view.
I think it's a fair point that it's to an extent a core activity to the business, and you cannot operate in an environment where you mentally think that this has been completely outsourced and somebody else will take care of it. Fair point. And hence probably the moment you start thinking about certain scale, you need to build these capabilities in-house. So Sesh, coming to you, once again, I think we talked about multiple instances in the last 40, 45 minutes where there is a certain action that is happening in collection, and that feedback loop needs to flow back into policy. We talked about policy. We talked about journeys. We talked about how do you think about the onboarding process and so on and so forth. Now, in a way, collection has been set up today. It's somewhat as an isolated function, right? How do we figure out a way that this gets integrated into the mainstream organization and there is a proper feedback loop with the rest of the organization to enable it to do some of these things better?
Thanks, Abhinav. If you were to actually look at the, the theoretical construct of lending, you start with a target market, you have a hypothesis on how you're going to lend to that target market, what criteria you're going to use, how you're going to maintain the account, and how you're going to collect on it. And then there's a feedback loop basis performance so that you change it. Now, that feedback loop is important, and currently I think most of the feedback loop comes through statistical analysis of how the portfolio is doing by segmenting it and finding, where you have problems and where you don't have problems and trying to eliminate those areas. You're right, I don't think many organizations have a mechanism by which we get the collection folks involved, and I think that's a good idea. I think there has to be a framework where you do some form of a portfolio quality, analysis on a periodic basis where everybody who's involved in the business sits around the table and discusses. The problem is that collection feedback often tends to be anecdotal. There's this one case where this guy did this, or there is this one instance where something happened which is out of the ordinary. And anecdotal information cannot really drive decision-making in a portfolio setting. And that's the issue in trying to incorporate collection feedback. There could also be instances where it's very valuable. There is a particular city where you're seeing a particular type of delinquency and default. Those can be quickly incorporated into your decision-making process. But otherwise, how do you translate anecdotal information into usable portfolio-level information is something that we still have to crack. I think there are issues with that even now.
That's a very fair call out, that we cannot immediately swing to the other end of the spectrum whereby whatever collection is saying becomes gospel truth, right? So it has to be more data backed. It has to be at a level where it is a more structural input than an anecdotal one. Fair point, fair call out. Mr. Binod, I'll ask the last question from the panel perspective. We have discussed a lot about what do banks or NBFCs need to change internally, right? From data, analytics, process, digital, everything perspective, what can be done? But are there anything that we expect from regulator or from the industry as a whole to probably make it easier to collect? Are there anything that comes to your mind?
Very right question, Abhinav. So if you remember, a few years back, RBI came out with a guidelines for opening of current account. They started monitoring current account of more than 5 crore. So if you are a borrower, there are certain restrictions. You can open current account with only few banks. So can we now, is it right time, I will pose that question, is it right time to bring that threshold down? Maybe to begin with 1 crore and thereafter further. Because that brings discipline in the customers, in the borrowers. And that is ultimately in the interest of the entire system, for the borrower also, for the system also. So that is one point. Second point, I will also like to, like we have acrylic data, wherein we collect information about the customers. Can we have some aggregation of that sort on retail side, I will say? Because for business, a current account opening can manage. For retail, can we have some deposit account aggregation, particularly for the persons who has taken loan from the banks, so that in case of any default, we can resort to that account. So that is my second thought process. Third point, briefly Mr. Seshadri touched on. I appreciate many initiatives has been taken to protect the rights of the customers. KFS, etc. has come. That is really a welcome move. But can we think about something for the lenders also? When somebody try to defraud or somebody try to give false information, can be some restrictions on them. So this is the third point. And last point, see, now individual credit score is akin to rating of the corporates. So that has become very important. So at industry level, we need to make awareness for all the customers, because if somebody, and in many cases it is happening also, and that is cause of concern also. Few people taking small loans, they are spoiling their CIBIL score, or they are spoiling their credit score. Can we collectively create an awareness campaign for the customers? It is very important. It is your rating basically. You cannot spoil this rating. And if something happens, it will be in the history for a long number of years. So these are few suggestions that is in my mind, which may ultimately benefit entire industry and may also reduce burden of collection. Thank you.
Job advertisement, which asks for some minimum credit score, isn't it? So credit score has become very, very important.
So let me just add, I think, what Vinod said. I think one of the important points which I think Sudipta also initially touched upon, this whole thing of daily reporting would be the big transformational change. Because more, again, as you've seen on the onboarding side, we've seen people taking multiple loans, so that can be handled at the selection stage itself. And again, if someone is defaulting, if you have a daily reporting mechanism coming, that would really help across in an efficient collection. There's some work which is already started by our Chennai-based startup. So hopefully we should see some work evolving around it. I believe that would be the real transformational thing in collection.
The reason why I'm a little hesitant is that I don't want to come across as saying something inappropriate. See, the fact that very often people miss is that in a banker's calculus of what you charge a customer, the cost of credit is an integral part. So it's basically your cost of funds plus your operating cost plus your cost of credit plus your profit expectation that drives the price. Now, if cost of credit is high, the resultant cost of the loan to people is high. Therefore, it is in the interest of society to reduce cost of credit, and that can only be done if you have an effective method of recovering what we put out. So, and essentially the people who default are a small fraction. And the more protection they are provided, the higher your cost of credit will be. I mean, I'm not saying that you shouldn't provide them protection, but I'm just saying that this is the strange contradiction that we have to deal with. So if you want to drive costs down, you need to make this a little bit more easy for us to deal with.
So in a way, if I read it like the nutshell is capital cannot be traded for interest. So a lot of time it is understood that some risk is there and we price it, but it's not all the time price is immuning the portfolio, right? And there the mistake happens. Some governance in terms of to what extent the interest should be for a specific loan can be a good measure, so that the undue systemic risk can be avoided. Because when a customer borrows, he's not borrowing from one bank, he's borrowing from multiple banks. If any of the 2 or 3 institutions are disproportionately charging the interest, the entire risk is flowing into each of the banks. So those systemic interest risk, if it can be addressed with some governance, will be a great feat for the industry.
Okay. I think the last question seemed as the most overwhelming response from all the panelists, because it was something that others have to do. So, any questions from the audience? Many hands going up, but we'll have to get the mic there. Mr. Tangsale.
Hi, sir. My name is Swarali, and I'm from Prisol 360. So,
it's not a question, but I'm leaving a thought on the issue that very rightly said by every lender, that is the underwriting standards which really makes all the difference on the credit cost and the collection efficiency. Now, underwriting standards, unfortunately, in all institutions are common across the geography, across the sectors, across the demography. Could the lenders think of having a differentiated underwriting patterns, understanding the patterns, the behaviors? Now you have got all the behavioral patterns available through the Gen AI. I think all the credit bureaus are giving the geographic-wise pattern, sector-wise pattern. So if the differentiated underwriting standards could be created, maybe it will be useful to improve the collection. It's just a thought, food for thought. Thank you.
But Sesh, I know you have worked on this.
I would like some banker to respond to it.
No, absolutely. Sesh, you have worked on this quite a bit at multiple banks, thinking through differentiated swim lanes on the underwriting side.
Again, I hesitate to say what I'm about to say, but the issue comes from the presence of the bureau. Now, whenever you build a scorecard, very often the most predictive variables come from the bureau. And since all of us use similar technologies to build scorecards, all our scorecards tend to mimic each other's scorecards. That's essentially because the most predictive variables are bureau-related variables. Therefore, it will take us to actually step back and use other methodologies which are as yet unproven, because the bureau works. We all know these scorecards work. So from a banking point of view, we will need to step back and say, okay, now I'm not going to use this bureau because this is going to drive me in the direction where every other bank is going to go. So there's a clutch of customers who are overbanked, and then there are a clutch of customers who are underbanked because of the nature of how this thing actually evolves. So I think it's a very interesting question. I unfortunately don't have an answer for it.
I'm not saying to do away with the credit score. I'm saying based on your own root cause analysis in-house and relating it to the various databases which are available, should you think of? I mean, I'm just leaving a food for thought. I would like Binod to respond.
So I'm just thinking of a small touch on it. The credit bureau is definitely one of the important aspects to underwrite, but it is also important to read on the liability scores. Because a lot of time when we see customers are getting into speculative investments by loan, why can't we read on the liability? Because Bureau will not be giving insight in terms of the speculative investment, but definitely reading on the bank statement, be it through account aggregator or native bank statements, that gives enough insight who the customer is, where he's spending, what his life stage, lifestyle, that can be read. So those persona can be the next feed lift in the scorecard.
Hi, sir. My question for the panel was basically that let's take an example, an account gets NPA, right? With the collections team, I believe that the legal also plays an important tool, right? So we have seen that a lot of retail banks are, and especially when it comes to the retail products, are using tools like arbitration and mediation. So wanted to just understand the panel's opinion on the current online dispute resolution platforms which have come into picture as a part of collections.
Largely online dispute redressal, right? So when the lending is largely digital in nature, there ought to be litigation should be also digital, because today the entire judiciary system is burdened with too many cases, and one cannot expect resolution happening on the fly. But definitely the customers who have taken loan, they have larger likeliness to get themselves registered through ODRs, online dispute redressal. So neutrals are there. When neutrals can do a mediation, can do conciliation, if not getting through arbitration is also possible, and awards can be passed. Are these being used by the banks today? Yes, indeed, these are used largely for the granular products to make sure that the judiciary system can be decongested and the customers and bank can have a neutral position to close those loans.
Understood. Thank you.
My question is, we are talking about the collection. So whether the repayment is in direct relation to the cash flow, and whether, because generally, we fix up equated monthly installments and all, but the customer's repayment capability on a seasonal, there may be variation also. So using the technology now, are we trying to really, because fix up the schedule of repayment in such a way, such variation can be taken care. Otherwise, generally when you leave it to the whatever field level, my experience has been, it is nowhere relation to the cash flow. And you will make quite a lot of accounts on the difficulty of recovery. Yes, Raju, you want?
Yeah. So, sir, you are very much right. And you find that in agriculture advances, I think the repayment is linked to the crop season. So, of course, the repayment schedule has to be linked to the schedule of the inflow of the cash, and technologies are there, and banks are using it, and we can always sync the repayment schedule to the cash flows. And particularly, I'm aware that in agriculture, I think the repayments are half-yearly considering the 2 crop seasons that we have.
Just to add to that, to see, for bigger, larger accounts, we normally give ballooning also, we take care of the seasonality also. But with the help of technology now, we can have exact cash flow stream of the borrowers, and we are using in smaller accounts. If they have a cash flow, say during the weekend, repayment can be go for the weekend also. I mean, weekly repayment schedule, monthly, or depending on their cash flow can be fixed. So that is helpful with the help of technology. Yeah.
Mine is a question as well as a food.
Please, when we introduce the India AS accounting, which is there now next coming, that time it is depending upon your judgment as to the future cash flows. So, and you have to again arrive at that and then decide about the, not due to the 90 days, all that. So how we capture this cash flow in all the accounts, that is becomes not only during the time of sanction, but on the other side also. Actually, that technology and that capability bank has to develop. Then one is on a portfolio basis also, but some of the bigger accounts you have to do on an individual account basis. So that will be a very relevance.
Okay,
Sir,
this is the last question.
Sure.
Yeah.
So it's more of a question as well as a food for thought. I mean, and I'm also talking from personal experience, a new NTC as well as an NIP customers where, once you've underwritten and you've dispensed with the loan topic is efficiency of collections, right? My understanding is that, defaults happen due to only two reasons. One is inability to pay, and the other one is intention to pay, right? And typically out of 100 loans, let's say 8 fall into this category. It's not 92, obviously, do pay based on empirical evidence. But there is a very simple mechanism which we had used during our, early days of unsecured lending, which we used to tell the guys that, boss, you got a phone, so we get the the NACH mandate. If you default on the NACH mandate, you will get a call. And if you, in the call, we said that, boss, we will give you a collect transaction on UPI, which is going to be, valid for 48 hours. So you better go and, deposit the cash so that when the UPI collect hits, the payment gets done, right? So if it is not there, then, out of those 8, at least 4 used to, get solved. The balance 4, then you again find out whether it's again inability to pay or intention to pay. So my question is that there is already mechanisms in place. All it requires is automation, from the banks. So why are we not doing it if my hypothesis is correct?
Anybody would want to comment on the feasibility of automation? Yeah, Pankaj, please.
I think I mentioned the importance of this initially when we spoke about the collections journey implementation. So few of the banks, what you're already talking, few of the banks and NBFCs have already implemented it. And I believe as an industry, we will be moving towards more of do-it-yourself mechanism, omnichannels collections mechanism being present for the customers.
Okay, thank you so much.
One question.
I'll request them to stay over the lunch. I will really request them.
Thank you.
Yeah.
Thank you.
Thank you so much. Thank you so much.
Thank you, all dignitaries. Ladies and gentlemen, it's time to break for lunch. Please be back by 2 so that we can start our next session on time. May I have your kind attention for the lunch venues? Managing committee members and the speakers, please join us for lunch at the Sunset Lounge on the pool and spa floor. And for other delegates,